Welcome to the Nasdaq Market Site. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. And on the eve of the annual Russell U.S. Indexes Reconstitution, FTSE Russell, Nasdaq Trading Services, and special guests join me. The panel will convene on market expectations in advance of the annual rebalance of the Russell U.S. Indexes on June 28th, examine current trends in the U.S. equity market, and touch on potential investor product and asset allocation strategies going forward. Joining me for 2019's panel is Ed Coughlin. He's the Director of Trading Services at Nasdaq. Rolf Agather, he's the Managing Director of North America Applied Research at FTSE Russell. Nick Kalivas, he's a Senior Equity ETF Strategist with Invesco ETFs. And Stephen DeSanctis, Head of U.S. Mid-Cap and Small-Cap Research at Jefferies. Gentlemen, thank you so much for joining me for 2019's panel. Always great to have everyone with us in studio. Ed, I'm going to kick it off with you. We're going to learn about the mechanics behind the cross. Tell us more how the closing cross works. Can the market handle the glut of volume and volatility in just one print?
It always has, and I believe it always will. I mean, Nasdaq spends a lot of time, money and energy dedicated, putting resources forth that the market participant can trust the market plumbing on that day. So Russell, to us, while it be the busiest trading day of the year, we have normal operations. Obviously, we're extra staffed and whatnot, and we prepare for it as a special event. But to us, if you look at last year, we traded 1.2 billion shares in the cross, $39 billion of notional value. And what's amazing to me, that transaction takes place in less than a second. What technology has allowed us to do, I continue to be amazed by what it allows us to do. As far as the process, it's no different than any other day. We want people to have trust in the systems. They will put the same order types in, the same time frames are allowed, the same protections are in place. We have more eyeballs on things, but other than that, it's a very normal day for us.
All right, now Ralph, set the stage for us for Reconstitution. Are there big changes expected for this year? Any updates to the indexing methodology?
And to be honest, we really don't like big changes. We don't like to have surprises. The whole point about this process is that it's very transparent. It's very rules-based. Anybody can go out to our website and look at the rules we're using. Typically, we do make enhancements to the methodology every year. This year, those are actually fairly minor. This is actually one of the quietest years that I've seen in a long time with respect to some of the enhancements we've had to make. They're really more clarifications of existing rules, for lack of a better term. And I just wanted to comment on the closing cross as well. I think for Russell, again, the closing cross for us has helped, just improve that transparency that we think is important. There's over $9 trillion of assets following the Russell indexes, whether that's active or passive. About $1 trillion actually is passively following the Russell indexes. So transparency for us is paramount. This is actually, I think, the 15th year that we'll be using the closing cross. We started, I think, in 2004. And again, just as more and more money has been following the indexes, it's very important that that mechanism helps us with the transparency that people can expect.
All right.
And let me add to that. When you talk about transparency, and that's kind of what I would say a hallmark of what the religion is at Nasdaq, that everybody has fair and equal access. There is no special person that has a unique look into things. Every participant is getting that data and is looking at the same information at the same time and can respond. And it's shown to be very, very effective.
All right, Stephen, let's talk about the markets for a moment here. How do you assess the current backdrop for U.S. equities?
Well, I think the big thing here, right, is that we're going into a G20 meeting and we have Russell Reconstitution. Believe it or not, this is not too dissimilar than a couple of years ago when we actually had Brexit on the day of Russell rebalancing. And I think what we like to talk about is the fact that the rebalancing does provide you with additional liquidity. If you want to make portfolio changes for the second half of the year, now is the time to do it, given the fact that you've got a lot more liquidity. Turnover this year is actually down from previous years. I think there are a couple of things that kind of stand out. One, decimated energy becoming a bigger deal for value managers. How do they look at that particular sector? You've got some of the software names that have performed really well that are probably moving up to, or going to be moving up to mid-cap and large cap. How do people kind of think about that? You guys did a couple of IPOs today from biotech. Biotech's weight continues to go up in small cap. How do people handle that? What do they look at relative to where they are versus the benchmark and their peer group? The other interesting thing is that the top end of the Russell officially today is 10 billion, despite the fact that the next largest after the 10 billion is like 6 billion. So how do people look at the definition of small cap. And then lastly, definition of mid cap continues to get bigger and bigger. So right now the Russell mid cap is 37 billion top end, 35 when you announced the changes. It's a pretty big range. So I think from a size segment standpoint, people need to kind of think about from an asset allocation standpoint, what cap ranges they're covering.
All right, we're going to get back to that in the large cap and small cap conversation. But speaking of allocation, Nick, what advice do you give to ETF investors right now in terms of ETF allocation going into the Reconstitution?
Sure. So we see things kind of slowing down in the U.S. economy. We see a lot of geopolitics that are out there. But at the same time, we see the market, like the Russell 1000, is almost knocking on the door, a heartbeat away from breaking out of its range to the upside. So the idea is to try to get some exposure to the market, but do it in a lower risk type of way. So think about something like our USLB, which is low beta, equal weight. That's a way to get the exposure, but use the quality screen of actually having a profit in the pool of stocks in the portfolio, and a lower beta relative to the market to try to smooth out some of the risks that might be present.
All right, let's keep on the ETF conversation. I'm going to throw it back over to you, Ed. Are there any technical concerns around ETFs updating to meet the new indexing requirements?
No, none that we've seen. I mean, we're in contact with issuers, market makers, none that have been raised significant issues. I mean, as far as the trading related issues, and we talked about it earlier, the ETFs themselves are made up of the underlying indexes. These changes that are going to take place, are going to take place in the underlying instruments, the stocks or whatever the instruments are in the ETFs. And then the ETFs will correspondingly be priced in to account for those changes that take place.
All right, back to large caps and small caps. Do you think large caps are going to continue to outperform the back half of the year?
Right now, I mean, the earnings backdrop has really favored larger cap. Small cap earnings growth has been pretty weak given, a little slower economic backdrop in 2018 with the tax high. Now all of a sudden you've got earnings growth that's so much better for the large cap. I think you have a dynamic for large continue to do better unless we get a catalyst. That catalyst could be Fed cutting rates at the end of July. What does a trade deal mean? Do we get a trade deal plus rate cut? That could change the dynamic. I think the bigger change on the overall market spectrum has been just how well growth has outperformed, however you want to define growth. Russell 1 growth, secular growth stories, higher beta, whatever you want to look at. Growth has been dominating value for several years now, since 2016. Do we get a dynamic shift or regime shift in the second half because of some of these things that are going to take place?
But who's concerned about forward guidance? I mean, you hear it in every single earnings call that there is no clear global trading backdrop. They don't know what tariffs are going to look like. It's very unsure in terms of how currency is going to perform. That's why we're not getting clear-cut guidance,
Right.
or we're getting lower guidance for those reasons.
So first of all, as a company, what are you going to do? You're going to take
You
down
don't know.
numbers.
Yeah.
So you're going to bring down numbers. Now, the interesting thing is, how does the stocks respond with the numbers coming down? Do they actually go up? That might be more of a positive. Okay, people were thinking that it was going to be worse. They cut the numbers. Stock ends up doing a little bit better. What we've actually started to see around the flows in ETFs has been a little bit of a sentiment shift more towards cyclical exposure, whether that's energy, whether that's materials, and a little less into tech, a little less into healthcare. And unfortunately, financials have not been able to get out of their own way. And so they've continued to see outflows.
All right, let's continue the composition conversation. Nick, I'm going to throw that back to you. The Russell Recon, how does that affect some of the major Invesco ETFs like USLB, IDLB?
So it's actually going to change the parent index in the U.S. segment. And the impact is pretty small because all these ETFs are taking that parent index and then they're going to run a rule. So in terms of equal weight, you just have that index. Now all of a sudden we're going to equal weight the sectors, and then we're going to equal weight in the sectors. So the impact of the Reconstitution is relatively minimal. And I think the same thing can be said about USLB. It's going to just take the parent, it's going to run the methodology to get those companies that have profits, that have the lower beta than the market, equal weight, and that's the portfolio. So I'm not looking for a big impact.
Is that true for momentum as well, for the momentum ETF?
Well,
because you guys did the momentum one, which has been a real driver of performance.
so
or at least a
they
track.
all go through, yeah, I mean, they will all go through that process of looking at the new parent and then running the methodology to figure out where the strength has been in the market.
Does that happen next week, or?
That happens, it will be effective on the close Friday.
Okay.
All right, now speaking of the close on Friday, Ed and Rolf, I'm going to throw it back to you. A couple of questions that we got on Trade Talks was, what does a closing cross look like? Is there a bunch of traders in a room and they're all executing trades at the same time? What does it look like when you go across the street to 1500 to ground zero and execute this trade?
I mean, I guess I'll start with, it's obviously our member firms, our market makers, they're great, providers of liquidity. They're great partners of the exchange. So they are taking orders in from their clients. They are sending those orders to the exchange for exposure in the close. And the process itself, like any other day, we accept, all market orders or market on close, limit on close, and what we call imbalance only orders. From a market on close order would be entered up until 3:55 in the afternoon. What's important about transparency is at 3:55 in the afternoon, we disseminate information to the broadest, view possible to the public. And we tell the public at that moment in time, we give them on an individual granularity level the symbol, the side of the imbalance, the number of shares that we have in an imbalance, the number of shares paired, and we give them an indicative price. And what that does is, for example, if right now a stock was $9.99 offered at 10, and we had 100,000 shares paired and 100,000 to buy, and we couldn't offset it all at 10 with the current orders on our book, we would give them an indication of where that stock would close at this moment in time if we got no new orders. And let's assume we had enough sell orders to offset those shares at $10.20. So we would disseminate to the world that we have this 100,000 shares to buy. It's right now at 10, but it's looking 10.20. It's probably the vernacular in the industry to say, okay, the stock's looking 10.20 on the close. And what we hope to have happen, and what does happen in the world, is that people look at the close as a liquidity event. They may be holding this ABCD stock and they say, oh my gosh, it's looking up 20 cents, it's looking up 50 cents. You know what? I'll sell some shares at $10.18. Somebody else says, I'll sell it at $10.15, I'll sell it at $10.20. And in this open and transparent environment, you get the real competitiveness, the animal nature of trading and market making comes out, where people compete to trade against those imbalances. Mm-hmm. And what it leads to is this best price discovery process in which everyone has fair and equal access, everyone's trying to offset that close. And normally what we see is we see a closing of that gap. When we first announce the information of the imbalance, that price will come in. There are times when it will flip and go lower, but for the most part, we attract offsetting liquidity. And it's a great event. And Rolf, maybe you can talk to the partnership, I'm sure, with Russell. People are very, very happy with the close.
I would extend on what you've just described in terms of the mechanics and talk about what the benefit is then to our clients who are the index funds. So if you understand how index funds work, the way they're actually being measured, how successful they are, is how well they track the index. So at the rebalancing, the way we're going to price the index and the buys and the sells is at what the last reported price is. Now we're doing everything on paper, so we're not actually trading in the market. So what's important is that whatever we're going to say is the last reported price is also what you were able to execute at. So for the index funds, the closer they're able to actually make trades or value their portfolios compared to what we say is the price is going to give them a very small tracking error. So the benefit to our clients is their ability now to track the indexes very, very closely. That's how they're being measured.
Okay, a couple minutes to go here. Stephen, any favorite recon plays?
I think it's, well, from a sector standpoint, I do look at energy. It's been a down and out group. Sentiment's starting to turn up. You got value guys that have to kind of play and look at that particular group, I think, a little bit more. I think there's definitely some interesting names that you look at, whether or not they're being added. So how the IPOs trade, some of the new IPOs that are being added, how are they going to trade around Russell Reconstitution? Interesting is that some of the bigger IPOs that get done don't have a whole lot of volume in it, even though it sounds great. Their weights are so small because Russell has float adjusted everything that they're not necessarily as big as the market cap may indicate. There's always that other name down, whatever cap range that potentially sees some pretty big moves. I think the one thing that we worry about is the fact that this trade is on a quarter end, and we've joked about this before, but it really matters for our active folks where we get the cross done as close and as cleanly as possible. We've had some years where managers have given up 60, 80 basis points on the closing bell and had to eat that in the quarter. They may make it up in the third quarter, but when they go out to have a conversation about second quarter performance, it doesn't bode well for them. And so you want this to be a very easy transition where you don't have big spikes in any particular stock or group. We know that's going to happen, but you want to make sure that it's limited. We don't think we're gonna see something like that, but again, you just never know.
All right, Nick, we're going to wrap it up with you. Second half outlook, a little bit of ETF strategy.
So I would just continue to kind of position for slowdown. I mean, when I look into the crystal ball, it seems like new orders are weak. The inventory cycle is a bit of a headwind. We have these trade uncertainties. And so that's why I would be defensive here and then think as we maybe get very late in the year and early next year, we get more aggressive. And my stop out on that is if you were to cleanly close over kind of new high territory in the large caps and we actually saw a little more punch in the small caps, I would get more aggressive and I might switch to like an equal weight strategy where I can get some value and some smaller size exposure and really play out what could be a stronger market.
All right, gentlemen, thank you so much for joining me. Fantastic conversation. And thank you as always for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.